We often hear that gold could be the trade to go for if there's another market downturn. But with many forms of gold, be it bullion, coins, ETFs, or the stocks of gold explorers and producers, there are lots of options facing us. Simon Popple joins us now from Brookfield Capital, where he produces regular newsletters. Simon, welcome.
Hi.
We're talking here about a beginner's guide to investing in gold. Now, I know to a lot of people this may be a new area. How do we start this conversation between those that want to get into the market and haven't yet tried, and giving them an explanation of what options there are available?
Right, well, I mean, I think gold is going to be a new area for a lot of people. And I think particularly people who perhaps retired, who would normally switch perhaps more from equities into bonds to have a sort of a guaranteed income, are perhaps scratching their heads a little when they look at sort of either very low yields or negative yields as to what they should be doing. So I think now is a good time for people to look at gold. I'm not saying put all your money in gold, but I think it makes sense to perhaps have some exposure to it.
What is some? Explain the sort of proportions, because when we talk about a balanced portfolio, you want to make sure that you've got both ends balancing, and in the middle you've got a mix of all the options available. In terms of gold, are we talking about precious metals first of all, or are we talking just about gold? Do we include silver in this?
No, absolutely, absolutely. I mean, I think we do include silver, and I think the amount in your portfolio really depends on your appetite for risk, and also perhaps your views of the debt market.
Yeah.
And I don't think it's ridiculous to have at least 1% of your portfolio in gold, and a lot of people talk about much higher numbers. But I think that you should have at least something in precious metals.
Yeah. Okay. Let's take then a look at this the difference. I explained at the top there are all sorts of different options available. What are the advantages and disadvantages, very briefly, about the sort of different categories of investing and trading in gold?
Well, I mean, there are lots of ways you can invest in gold. I mean, there's paper gold, which is quite often through ETFs, and
you don't own the underlying metal in that situation.
Well. It's quite complex. I mean, taking physical delivery is unlikely. I prefer to invest in sort of tangible gold, which is why I like the miners. But even when you're investing in the miners, there's lots of different types of miners. You're taking lots of different types of risks, and you need to be aware as to what you're doing.
Yeah, I want to go into the miners in just a minute. But you talked there about the paper gold. You've got the bullion. You've got currencies or gold coins and so forth. What are the advantages and disadvantages of holding, let's say, a gold bar over coins?
Well, I mean, what I like about the coins, I mean, if you're buying sort of UK, Britannia sovereigns, for a UK investor, obviously international investors have to look a bit closer at this, but they're capital gains tax free, which is the first point. So
if gold doubles in value, you pay no tax on your advantage in holding a gold coin?
Absolutely. I mean, there's a slight spread on buying it and selling it, which is how the dealers make their money, but there's no capital gains tax on UK Britannias and sovereigns, at the moment. What I also like about the coins is that they're a lower denomination. I mean, even a coin, depending on what you're getting, is going to be sort of £600 to £1,000. But a gold bar is probably £5,000, £10,000, £15,000, £20,000. So in the unlikely event that you did need to use your gold coin to buy anything, at least you've got something that is lower value. Running around with a sort of £5,000, £10,000, £20,000 gold bar isn't going to be a huge amount of help to you.
Yeah, and of course the storage cost as well, if you do employ someone else to look after it, because presumably a vault at home carries its own risk.
Yeah, absolutely. I mean, I'd always recommend people use third parties to store their gold, because they've got the right safes, they've got insurance in place, and they know what they're doing. I mean, anyone who takes gold home, good luck with that.
Yeah. You brought along a couple of charts. I'm interested actually. Let's start off first of all with this analysis of a balanced portfolio. When we were talking about getting this together, you likened it to fantasy football. This immediately attracted me. Not that I'm interested in football, but it gave me some sort of perspective. Just quickly run through this, because we've spoken about the different sorts of metals and what's on offer there, and the producers and explorers. Tell us how this all works out.
Well, the reason I do this is to try and explain it to people in perhaps language they're more familiar with. And what I'm talking about here is the stadium is your physical metal. I mean, top to bottom, stadium's least risky, forward's most risky. So if you've got the physical metal, obviously that does bounce around, especially with silver. It can be very volatile, but it's the least risky way of having exposure to gold or silver or a precious metal. The goalkeepers are the really large mining companies that produce huge amounts of gold or silver or whatever the commodity is. And the reason these are lower risk is they've got lots of different mines, they're in lots of different jurisdictions. So if you invest in a goalkeeper, you're investing in a very well diversified operation. Defenders are generally still, fairly large companies. Quite often they've got a market value of, $1 billion or $1 billion plus. But they are probably more exposed to one or two countries, one or two mines, and you tend to find with these companies, if they get some good exploration results, that can move the needle a bit as well. So they are predominantly concerned with production, but there's a sort of exploration angle with them as well. The midfielders are people either new to production or close to production, but quite often they've got quite a large exploration angle to them as well. So they may have a small mine and small processing facility, but they're looking for more gold, and if they find it, the share price can move a lot. And the forwards are your out-and-out explorers. I mean, these are very risky, but if you do get some good exploration results, these shares can go up 10 times, 50 times.
I was going to say the
even 100.
The 10 bagger. Well, yeah, that would be nice, wouldn't it? But
it would be very nice.
Okay, so you've got there a wide range, and you say attracting a balanced portfolio. Do you approach it in taking a bit of each when looking at your portfolio? And you are an investor in gold. Do you take a bit of each of those levels, the different positions in the stadium and so forth?
Yeah, I mean, I think a lot depends on where you are in your life and in your investing sort of appetite and risk appetite. Personally, I invest in everything that I sort of put out there. But for people who are perhaps looking at gold, for the first time, I would suggest perhaps looking at the lower end of the risk spectrum until you become more familiar with the market.
The big gold companies.
The big gold companies have some physical gold with a dealer. You may have one or two defenders depending on where you are in your investment cycle. But I think that everyone should have some.
Yeah. Why mining stocks over bullion? What is it that we should know about that gives us an idea about the different dynamics that are going on here? Well,
what's interesting about the mining stocks is the leverage you're getting over the the gold price, because with a mining stock, if the gold price goes up, the chances are that the cost of production won't go up by the amount of the gold price. So what you end up doing is having some margin expansion, which increases the profitability of these companies. So when you have a gold bull market, for want of a better term, what you tend to find is the profitability increases quite significantly. In this example, you can see that a fairly modest 20% increase in the gold price delivers a 75% gain, assuming costs stay the same. But even if costs go up, you're still talking about a 47% gain against a 20% rise in the gold price.
Yeah, and that's with costs going up 10%. So do costs tend to rise for gold producers when the price of gold goes up? Why is there not an economy of scale? Why is there not an opportunity here to or just to sell more at a higher price, or the same amount at a higher price?
Well, costs do. There is a lag, because what you'll probably find is that geologists and people involved in the mining process, when they see the gold price go up, they may ask for more wages and things like that. But it only goes up by a certain proportion, because there'll come a point where other people start entering the market to drive the cost down. So yes, they go up, but generally you'll find that the gold price is far more volatile than your cost base.
You started off by talking about the different stages of one's investment lifetime. Early on, one is assumed to want to take on more risk when you're younger, because you've got more time to make up any difference. What are the the most risky parts of the investment market in gold, what would you consider to be a good portfolio makeup for someone that is young?
Well, I mean, if you're young and you've got plenty of years of income ahead of you, then you can take more risk, and therefore people who are perhaps in their 20s, 30s, 40s. I still recommend they have physical goalkeepers, defenders and midfielders, but they can probably have a few forwards and have a bit of fun with that. Yeah. But as you get older, I'm not saying you shouldn't have any forwards, but you should have a far less proportion of your wealth in the forwards. And when you sort of perhaps approach retirement, I'd say the same for midfielders as well. But it's all about balance. These stocks, they can move quite a lot. So not only do you want to have a balanced portfolio, but you also need to have a discipline about when you sell. One of the problems that people have, in the last bull run, it's probably a bit like real estate, where people, they get into it. They're initially thinking about spending, let's say, £50,000, and then it goes so well for them, they spend, £200,000. But if it collapses, they would have lost 50. Now they're going to lose 200. And it's the same with the gold market. You need to take some money off the table and make sure that if the bull market does finish, which I don't think it will finish for quite some time, that you're in a good position.
Yeah, we're at what, 1,550 at the moment, I think, as we speak.
Yeah, I think we're
close to 2,000 was the all-time record high.
That's right. I mean, that was back in 2011, and there's lots of sort of forecasts out there. You have to be quite careful about what you say. But I mean, I think that even if the gold price approached 2,000, there's so much money to be made by the mining companies, especially if they can keep costs down, and they're far more disciplined with costs now than they used to be. It should be a good time for investors.
One other thing I think we've got to talk about is the currency risk, because there is a currency risk. Gold is priced in dollars. We've just spoken about the 1,550 level, 2,000. That's the dollar price. After the Brexit referendum, when sterling fell, gold was all of a sudden, to us, buying in sterling at a record high.
Yeah, I mean, the thing I like about gold, especially the gold mining companies, is you can, yes, gold is priced in dollars, but at the end of the day, gold is an asset that is considered valuable everywhere in the world. And so just because you invest in dollars doesn't mean you need to liquidate in dollars. So the gold price in dollar terms obviously has gone up, but if when it comes to sell your shares, you decide you want to liquidate for sterling or Aussie dollars, Canadian dollars, whatever it is, you can do that. So, and the chances are that the gold price against currencies has done very well.
Yeah, Simon, we'll leave it there. But thanks indeed for joining us, talking about the options available to those that are looking to gold as an investment. And as Simon was saying, for those that are just starting out in the market, it could be bewildering. And if you wanted to contact Simon, you can do through his website, Brookfield Capital.